So what type of deals do you like doing? Because I've noticed a few deals that you've done recently, where they're placements, but if it goes right, if it helps the company get to where it needs to be, it's great. It's good for you. It's good for everyone. But you're papering these things, so if it doesn't go well, it's a slightly more painful upside for you, in that it means the company hasn't delivered what it said it was going to, and presumably you're either perfecting some kind of security, or you're taking a bigger chunk of the company because they owe you. Well, it depends what the terms are. But what's your favorite kind of deal?
That really depends. As you probably know, I prefer now in my declining years to be a lender rather than an equity investor. The reasons for that are fairly obvious. In the bear market that we endured in the last decade, the Toronto Stock Exchange Venture Resource Index, which is the index against we're measured, fell by 88% in nominal terms in value, which is to say that the performance over a decade was minus 88%. In our on-balance sheet lending activities during the same period of time, we generated a 15% annualized return on capital employed. 15% is a handsome headline number in any circumstance, but the relative performance is silly. Really, 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 truly silly. Yeah. The idea that I can effect a reward transfer without very much of a risk transfer, and I leave the shareholders and the management team the upside, but I eliminate the downside for me, is extremely attractive. As a lender, if you're lending money to an issuer with no visible means of support, no visible means of repayment, you are really truly an asset-based lender. So we look at all the financial projections associated with the loan, and we certainly consider that, but we look at the management resumes, and more particularly, the strategic value of the asset to other buyers, assuming that our borrower wobbled. And that's the criterion that we use to make a loan. We are more concerned with loan covenants and restrictions, frankly, than we are with coupon, because one bad deal obliterates the return on 12 good deals. When you look at our track record relative to our competitors, and by the way, we have some very, very good competitors in that space, I think what you'll see is that other guys at periods of time have written more business than us, but we have had to foreclose much, much less often. That obscures the fact that probably 40% of the loans that we've written in the last 30 years have violated one or another of the loan covenants over the course of the loan. If we have a management team that is honest with us, works hard, and gives us prior notice that they're experiencing difficulty, we'll move heaven and earth to support them. If, by contrast, we don't get a call and we don't get a check, then the relationship gets different.
Yeah, no, I've seen both sides of that. I've spoken to someone this morning who, it's a very positive experience with you guys. They basically paid off the first loan, then got another loan, and great. You've allowed them to grow, be able to tell that growth story, deliver that growth story, and likewise, I've seen where it hasn't worked out, but no one really wants that. Well, maybe that's not true. Sometimes that's what the terms are geared up to do, but it's not easy. It's not easy.
We're not in the loan-to-own business.
Right.
We're lenders.
Perfect.
If we have to work out a loan, if we have to operate something, we've failed because it takes us away from what we're good at, and we think it damages our reputation on the street. We've had a relationship providing both debt and equity to the aforementioned Ross Beatty going back to 1987. A very, very long time. The first negotiation between Ross and I probably took 35 hard, bloody hours. And I don't think that the sum total of negotiations that we've done since, which probably number 30, have consumed 3 hours. Once the trust was established, and once the basic framework of how we could do business with each other on various assets at various points in time in the cycle was established, the relationship was extraordinarily clear-cut and very, very mutually beneficial. And I think that's one of the things that Sprott looks towards in its issuer-facing business in every circumstance. We'd rather do more business with less people than less business with more people. We'd rather concentrate where we know that we bring value and we know that they bring value, and each side looks to develop a commercial relationship where everyone benefits.
Yeah. Again, thank you. You're not in the loan to own business. I get that, but when that second phone call comes in saying we need a little bit more cash, you're in the driving seat, though.
Certainly, we construct the loan based on the assumptions that the customer gave us, and we tell them ahead of time what it will cost them if they wobble. So if there are extension fees or if other capital is required, we will support them, but we won't support them for free. If our risk increases, our coupon is going to increase too. That's the way it's going to work. If we're supposed to be able to redeploy the money in 12 months and we don't get to redeploy the money for 30 months, we get it, but there's a cost associated with that because there's a cost to us.
Beautiful. Lost opportunity cost, right? We're getting to the end, you'll be glad to hear. That's the good news.
I'm enjoying the whole process.
So am I. So am I. So we've talked about retail a bit, but can we talk about another component of which is kind of really it seems to be prevalent in Canada and North America more so than the UK, or they're a different sort of animal, which is the broker relationship. Now, as you've got big, I asked about you being an 800-pound gorilla in the room. As you've got bigger, do you still have to work with brokers, or are they coming to you? I mean, how does it work now for a large $12 billion under management company in North America?
We spend a lot of money cultivating broker and dealer networks. And of course, we have our own small private wealth business. So we also have direct to retail and direct to institutional. But in terms of the big products, the physical products and the ETF, those are very much distributed through normal distribution channels in North America. We're working now to build out our UK and European relationships too. We have our first UCITS product, European fund, as a consequence of our acquisition of the Tocqueville Gold Group. And we have explored from time to time a London listing for some product associated with our lending and yield-oriented activities. So I think that you can look to us establishing dealer and distribution relationships in Europe to complement what is by now a very deep U.S. distribution network.
Fantastic. Okay, I look forward to that. I look forward to, certainly hearing about it, and I'm sure it'll be imminent once we're allowed to leave our homes on a permanent basis. Can you just tell us a little bit about the ETF funds that you manage at the moment, if you don't mind? Sorry.
We have two ETFs, the Sprott Gold Miners Index, which is a small competitor to the Van Eck product. Ours is different in the sense that it isn't just oriented towards liquidity and market capitalization. It's a factors-based fund. And we take margin and profitability and revenue growth into account. The nervousness that we have with the non-factors-based funds is that large companies, which may be shrinking, tend to dominate the market cap race. And we don't want to have a circumstance where we own a lot of a company that's towards the end of its mine life and we face a precipitous decline. So we look as much to margin and revenue growth as we do to market capitalization and liquidity. We have a smaller company fund, the Sprott Junior Gold Miners Index, which is similarly focused on factors rather than market capitalization and liquidity. The truth is that our ETF offerings are substantially smaller than Van Eck's ETF offerings, and ours are small enough, this is convenient and inconvenient, that we do not move markets. When there are inflows into the major ETFs, especially the major junior ETFs, their rebalancing becomes in the near term the most important part of the market capitalization of their constituents. We are unfortunately saved that challenge by virtue of the fact that we're smaller, but factors-based. We suspect that over the course of the decade that we will be able to handily outperform them because we think that a blind ETF will always underperform the market to the exact extent of their fees. And we hope that by tailoring our own offering to some factors which are pretty easy to construct algorithms for, but are also important over time in success, that our factors-based approach will overcome the impact that they have on markets as a consequence of their gorilla status.